If you are paying attention to any of the headlines at all, and you probably think, oh man, I'm probably not gonna make any decisions right now.
Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm.
But what I would invite you to consider is that real estate is a hyper-local industry. What's going on, everybody? I'm Dan the Realtor, your local DMV real estate agent. Real estate is a hyper-local industry. And that means you can have a hot market on one area and not so hot a market in another area. So today, we're gonna be talking about the local DMV real estate. So the first thing that I wanna do is address the elephant in the room, which is SVB, Federal Reserve, interest rates, and the local DMV market, and how that all plays together. First, let's start with some background on SVB. Silicon Valley Bank is a financial institution that provides banking services to startups, venture capitalists, and private equity firms, and has been a major player in financing some of the most successful technology companies in recent years. The Federal Reserve is the central bank of the United States, responsible for implementing monetary policy to achieve stable prices, full employment, and sustainable economic growth. The Federal Reserve has tools at its disposal, including adjusting the federal funds rate, which is the interest rates that banks charge each other for overnight loans. Now, interest rates play an important role in the economy and the real estate market as a whole. It becomes cheaper for borrowers to take out loans, including mortgages. And that in turn increases the demand for real estate and pushes the prices up.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Conversely, when interest rates are high, borrowing becomes more expensive, leading to a decrease in demand for real estate and potentially lower prices. The Federal Reserve can influence that interest rate by adjusting the federal funds rate. When the Federal Reserve wants to stimulate the economy, it can lower the federal funds rate, making it cheaper for banks to lend money and therefore for borrowers to take out loans. When the Federal Reserve wants to slow down the economy to prevent that inflation, it can raise the federal funds rate, making it more expensive for people to borrow money and can potentially decrease the demand for real estate. So in other words, when interest rates go up, prices go down. When prices go up, interest rates go down. Okay. So how does all this SVB, Federal Reserve, banks, what does that have to do with the local DMV real estate market? Funny you should ask. If the Federal Reserve raises the interest rates, that could potentially slow down the real estate market because it will pull a lot of the buyers out of the pool. And on the other hand, if the Federal Reserve keeps interest rates low, that would increase the amount of buyers that are already present, and it will push prices up because there'll be more buyers competing for the same amount of profit. It's important to note that there are a lot of other factors that affect real estate other than just the interest rate, including supply and demand, population growth, and economic conditions. According to an article just published by the Wall Street Journal, the United States is a country of two housing markets. In one, home prices are falling from a year ago. In the other, they're still posting annual gains. That division runs right down the center of the United States. According to the Wall Street Journal, this pattern of geographic disparity is highly unusual. So if you take a look at the map, you can see home values are falling in the West and rising over here on the East Coast. You can even see Boston, New York, Washington, D.C., where we are right here, Virginia Beach, Cincinnati over on the East Coast, Atlanta, Jackson, Orlando, Florida is 9.3% increase. Miami up 12. And then if you go over to the West Coast, Seattle's down 7.3. San Francisco's down 10.3. San Jose is down 10.3. Now, before we get to the local market here in the DMV, I need you to do me a favor. I need you to like this video and subscribe to my channel so that you're the first to know when I drop new content. So let's get into the numbers here in the DMV. So this graph right here is a smart chart graph that comes directly from the Bright MLS. So if we take a look at the graph, we can see the total amount of closed sales in February. Now, the total amount of closed sales in February is down 24.7%. However, the total closed sales is up 28% from January, month over month. The median sales price here in the DMV is $535,000, which is up from this time last year, 1.7%, and is up 7% from January. The average sold price here in the DMV is $658,915, which is up 2.3% from last year and up 3.7% from this time in January. These are very interesting numbers because, as you can clearly see, even though other markets may be experiencing declines, here in the DMV, we're still in a hyper seller's market and prices are continuing to go up. Why is that?
I don't know.
The answer is inventory. When there's more demand than supply, that pushes upward pressure on prices. So how do we determine the inventory? Great question. I happen to have that number right here. The way you determine the inventory is you take the number of new listings and you divide it by the number of pending listings. So what does the inventory number tell us? Well, the inventory number tells us how long it would take us to completely run out of houses if nobody else put their property on the market. For example, if we had 12 months of inventory, that would tell us that we're in a hyper buyer's market, and buyers basically could take as long as they want to buy a house. It would probably still be there in 12 months. In a hyper seller's market like we're in right now, if no more houses hit the market today, it would take us 1 month to completely run out of houses for sale, which is extremely short, which lets us know that here in the DMV, we're still in a seller's market. As of February, the number of new listings that came to the market was 3,927. The number of new pendings was 3,922, which basically puts us at a break-even point. As soon as they hit the market, they fly off the market. Right now, if you divide 3,927 divided by 3,922, that gives you 1.00. That lets us know here in the DMV, we're in a hyper seller's market. And this is super important when it comes to you making a decision as to whether you want to buy, wait, or sell.
I'm here to help you with whatever problems you might have, okay?
Another interesting point is that we're having an increased days on market. The median days on market from this time last year is up 185.7%. Now, it's down 33% from this time last month in January. The average days on market is 35 days, which is up 40%, almost double from this time last year, and down 5.4% from this time in January. The days on market is a very interesting variable because in the past 2 years, the days on market was really indicative of the buyer demand. In traditional markets, the longer a house sits on the market, the less valuable it becomes and the more likely you are for a price reduction. But in this market, because the inventory is so scarce, the days on market is almost irrelevant, as you can see by the numbers. We have extended days on market, but the prices are still going up in the DMV. The last thing you'll want to consider in this market is where are prices going. Let's take a look at this graph. In 1990, the average home price was $94,000. At around 2006 to 2008, during the Great Recession, the average sales price dipped to $222,000. And at its low point, it went to $166,000. But it never went back down to the $94,000. At its lowest point, it was at $166,000. And then it continued to creep back up until it balanced out in 2016 back at $222,000 average sales price. Then it skyrocketed in 2022 during the pandemic, where we had our highest average sales price of $386,000. Then it kind of trickled off, and now we're at around $357,000 nationally. However, if you look at this chart, during the year 2022, our highest average sales price was around $600,000. Then in January, it dropped to about $500,000. And now it seems like the average sales price again is starting to creep back up here in the DMV. All right, Dan, so what do all those numbers mean? The most important thing is not to try to time the market and try to jump in when you feel the prices are going to be lower or the interest rates are going to be lower. The ideal time to transact in real estate is when it fits your situation and when it works best for you and your family. If you're looking to sell your home, now is a really good time to do so because we do have such a shortage of inventory. The challenge is going to be buying a house on the other side because we have such a shortage of inventory. Now, there are 5 big issues that are facing the housing market right now that could really affect your ability to buy or sell real estate this year. If you're interested in hearing more about that, take a look at my next video. I'm Dan, a realtor. I'll see you next time.